Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 23rd, 2024. It's 11:07 a.m. Eastern Time as I'm starting the video. And here's what I'm going to cover in this one. I'm going to start out with the big boy on the block now, NVDA. Seems we've narrowed the focus from the Mag 7. A couple of those kind of dropped out of that, elite club. So I was calling it the Mag 5 lately. Now it's really the Mag 1 carrying the market. Other than Meta, of those Mag 7 stocks, Meta just eked out a new high. This is the only one that's at new highs for weeks now. We haven't even seen any of the others take it out, which is, it's not bad. They're not, the majority other than Tesla aren't way off the highs, but just worth noting with the S&P making a new high yesterday. But here's what I'm going to do. I'm going to cover the charts. I noticed something last night in reviewing the charts I wanted to share with you, and I'm going to start out here on the video and really just their kind of recent pattern of earnings. You can see this is my busy board. This is a chart I've been covering in the video, and remember we still have these purple lines. That was the last time we went long the market, long tech, everything back there when it wasn't just NVIDIA, all the big, actually take that back. Maybe NVIDIA was well above its purple lines. Oh yeah, it was on its purple trend line. So it's hard to see here. I know this is what I call my busy board. I'm going to switch to a clean board, but I've had this trend line on there. I'm going to extend it now to the right. And that's the one that video is trading. I might have to tweak it right there, but it's the primary uptrend line, comes off the October lows. A very significant trend line, and certainly a potential target for the next tradable pullback. So let's talk about that real quick. Technically speaking, other than a new high, nothing's changed in the outlook. The same divergence as we had going into the earnings, with the stock making equal or lower highs on the indicators from this point to this point. They're still very much intact. And so what you can see here, and this is what I noticed, I've had these lines here. I started tracking the stock for earnings in advance of earnings. You've probably noticed that on some of my charts on the market leaders. When they're coming up to earnings, I'll put a line up just for my own reference, when to be aware, get out if you're in it, or get just be aware that you're going to have that earnings report, whether you're trading it or not, especially if it's a market mover. So you can see here Wednesday 8:23 after market close. What I'm going to do is I'm going to turn off, I'm going to switch to what I call clean board without all the lines here. And just remember, this was a very, very significant breakout. In fact, I'm going to color up that purple. I'm just using that as a significant color lately, because that was you had this multi-month trading range and a breakout that it hasn't looked back on until we caught that first pullback trade into the earnings the other day. And let me turn off all these, or let me go to my clean board now and show you. So this is what stood out to me. And again, this is the in over the last year or so. These are your quarterly earnings reports. So the lines mark the earnings dates. Remember, NVIDIA, like most tech companies, reports after the close. Banks tend to report before the open, and a lot of blue chips. Tech likes to report after the close. Don't ask me why. It's just how things are. So you got to remember that. And then the next day is what you're going to see. That's the day of the report. So back here on in August, there was your almost identical pop, big green candle, big up day, and that marked at least for the time being the high. So and a lot of folks did. You can look at volume. A lot of folks bought that high yesterday. As well as that one. Oh, and that's the other thing, guys, by the way. Let me make sure you can see it here. Let me turn up my volume bars nice and bright. And that's the other thing to note. So there's two things that stood out to me when I eyeballed this chart yesterday. Is number one, a very distinct and notable volume spike. Not unusual on an earnings report, but so you had a big move up, big green candle, new highs in the stock, by the way. And then from there, if you bought that high, because everybody was foaming at the mouth bullish, from top to bottom, the stock dropped 22%. In other words, you never, ever got positive from that day. If you bought that high, you only lost money straight from there. You almost got back to break even here, got close there, and then boom, that. So, and that was a drop. You can see it over a few months. Here, there was their earnings report. Also rallied, the stock rallied into it, just like recently. And the next day was actually down, but then continued down. So either way, if you bought the high post on the day after earnings, it wasn't much, but it was a 10% drop. So the point is, two out of the last two out of three saw the stock immediately pop. Oh, and of course, look at the big, it's almost exactly here. I'm gonna take a horizontal line from this earnings bar. I'm gonna drag it over. All right, that's what I did. So you can see this one was a little lower here, right in line with this one from yesterday. So yeah, whatever. It's, is that hard evidence to short the stock? No. But does it show you a pattern of buy the rumor, sell the news? Like I said, and I think nobody expected the stock to miss earnings. It's just expected a blowout quarter, just like you do with Apple and everything else. So where we go from here, well, yet to be seen. The technical posture, again, most importantly, hasn't changed. The stock is in an uptrend right now since it's back above. This is just like Amazon. Amazon had that pre-earnings breakdown, and then pop back up above there. So I think this trend line is still valid right there. If those of you that want to try to see if history repeats. But right now, really not anything remotely close to a sell signal. It would just be a pot shot trade, and one that could or couldn't, may not pan out. On a related note, what is, and I'm just going to point this out yesterday too, is an objective trade still, is SMCI, because nothing's changed. Now, again, and I know, listen to my voice, there's those that just get swallowed up in the hype. But if you strip out everything and want to become a mechanical trader, which especially if you're struggling with trading and you're second guessing things, you're listening to Kramer or the next guy on TV saying no, don't buy, we're only going up or down, whatever it is. A mechanical trader will short. This had two sell signals recently, and the most important is that massive bearish engulfing candlestick. Again, it was highlighted there. I put up some fibs yesterday. I was watching the bounce. It probably got to the 76.8 fib. I didn't put that one up. There it is. Stopped cold at the 78.6. That's a typical retracement. A little on the higher end of the range. I usually like to see things in the 38 to 50, 61.8. But if you don't know what I'm talking about, Google search. I read up on Fibonacci retracements. They're a great tool to use in both trading, long-term investing, trading. You can use them on multiple time frames, but so far that's all that was. Now, again, I'm going to just speak to discipline and simplicity. So what you had is a bearish engulfing candle. You had a break of the uptrend line off the January lows right there. So you had not one, but two sell signals in a single day there. Now, the bearish engulfing candle is more of it's a very high probability. Trendline breaks are great in a strong trend. Sometimes you get them, you get a little correction and go up. But again, the way to trade this, and I said it that day, put it out as a trade idea. Take it on faith. It's a bearish engulfing candle, and they're super easy to trade because basically the stock should not go back above it or it's no longer a topping stick, because by definition, a bearish engulfing candle is a topping stick. Just like a bullish engulfing candle that comes at the bottom of a downtrend is a reversal stick as well. It's a bottoming stick. And so, take it, don't take it. I know right now most don't want to take it. And again, if you're already in it, but nothing's changed on a trading plan. If you took it before or you missed it, then yesterday, even today, you've had two opportunities on a bounce back rally to reshort at a better price, get back in if you covered in front of NVDA earnings, which obviously was a big risk to go long or short anything big tech, or especially AI related. Again, this thing is kind of living off the coattails of NVIDIA, has been well documented lately. So, remember these bearish engulfing candles. I'm going to use my little ER gunshot ruined analogy. I don't know why. It's the one that works. So, patient comes into the ER, they've been shot. Now, the first thing they do is they x-ray or open them up, see what kind of damage a bullet did. Sometimes it misses all vital organs and arteries, and you're great, no problem, stitch you up, give you a little antibiotics, whatever, take care, you'll be back on your way. However, it could even be a stomach shot, but it bursts some major aorta, some major blood vessel in there. And, you may feel fine when you come in. Hey, doc, it hurts a little bit, but tell you what, it's not that bad. But you're bleeding to death. You've got a ton of internal bleeding and they can't stop it. And then you die. That's what a bearish engulfing candle in trading or a bullish engulfing, that's what they are to me. And now, again, the patient may live and go in there and do emergency surgery if they can stop the bleeding before it's too late, control it. Otherwise, sometimes the damage is done. And so we'll see. Again, that's maybe a very simplistic analogy, but again, that's it. So you have that. And now you also have, 2 reaction lows the other day. So these are the levels. Bulls win here, bears win here. Okay. And it's a pretty big range. And where it goes will most likely depend on NVIDIA. And I just gave you the, history of NVIDIA. Let me change gears. And on a related note, let's just talk the Nasdaq. Let me flip over to that. Okay, this is to me the most important index right now. Has been for a while because of the concentrated weight of the holdings. The big Mag 7 can kind of get more clarity, if you will, stripping out everything else. And like I said yesterday, if you have to squint, I will give it, and I said it yesterday, I would not add to. In fact, made it clear the next objective short still comes on a break below the on what I've said. So we're lacking. We need to have QQQ, SPY, Meta, and Amazon all below lows from Tuesday of last week, and that hasn't occurred. So it's still not a it's still not a all-in or aggressive short moment, but it is this. We had one first sell signal there on the break of that minor trend line on the 60-minute charts, but this is showing it here on the daily. The next sell signal came here on a solid break below the trend. Oh, I'm sorry. The next objective short entry I pointed out was on the backfill of the gap right there and there. So you had 2 opportunities and then this one. And now we don't have yet the final. And as I said yesterday, I want to make it clear, you don't, you have to calculate and look at how much exposure you have and want. So any of those, if you took each and every one of them, but you already, at the second or third one at your full allotment, it doesn't make sense. Again, the way I've been talking this trade through, telling you my plan is not anything close to a full or all in until we take out those other lows that I talked about before. So it's still just a partial position. Now, even on a partial position, let's talk about that. From the first entry to today's highs, less than 1%. From that move as well, which was right where the breakdown was, less than 1%. From that third and last entry, from where we broke down and clearly started going below the trend line, it was about 2.2% even into today's highs. So speaking of this trade as far as stops go, but again, even though you might want to, again, it's virtually flat, it's slightly underwater if you average in those costs. And again, we're right on the trend line now. So let's see how today closes. They might not give us any visibility today. We might park again in very close proximity to the trend line. But like I said, at this point in time, now there may be things on the 60-minute chart, shorter term charts. The objective entries I see are still on a break below next Tuesday's lows on those 4 securities, 2 indexes, and 2 major stocks that I see. So would sit tight and be more concerned if short about stopping out. If we start to clearly walk away from that trend line, maybe take out the previous highs, by a fair amount on daily close, whatever you want to do. And if you're long, then look, buy pullbacks to trend line support. This was a pre-earnings, NVIDIA earnings whipsaw so far. But again, we're just trading right on that trend line right now, especially as I do the video, we're exactly on it at this point in time. So we'll see where we go. What could lift the markets higher, and from here, if it continues to play out, I told you yesterday I like Treasury bonds as either a paired trade or even an indirect play, because we have we're in the yellow zone, but we had nice bullish divergence in 60-minute charts. Here's IEF, so we broke out. So this is a buy signal. It's a trade idea, whatever you want to call it. The target would be, based on the scope of the wedge, another run back to the top of the yellow zone. Remember, that was yellow zone was price support, and we broke down, we rallied back. Support once broken becomes a resistance, so that's a natural target. And then if we enter the green zone again, that should be, all other things being equal, again, barring that it's not a flight to safety bid because something's breaking in the financial system or the market, that should be net bullish. And that should also tell you, hey, you don't want to keep shorting the indexes, or you want to make sure if you're still short, you want to consider taking, where to set your stops if you're not already, maybe scale out just like you scaled in, if that's what you did. Now, likewise, sometimes divergences don't play out. And so if this breakout fail, even if you go up there, if it doesn't fail and we hit that minimum target, that's an initial swing target, and you go back down, then that just tells us the market might have a little more upside this today and into next week or so, and then down. So this is still part of my trading plan. Now, the breakout today warrants a little bit of caution again with bonds on a buy signal at this point in time. Yesterday was just divergence and we were below the trend line. Today we broke out. So, and this is for futures traders, ZN. You can also trade ZB or TLT. This is, by the way, this is on ZN if you're a futures trader. This is where, that's my yellow zone. I don't have a shading tool on this program. I can only box it in here, but you can see my lines about 108, 255 up to about 110, 256. And again, as long as we remain in there, I used a red tool right there, but just remember that's yellow. Red's down here, I think below that 107, 158, and this is my orange zone there. So that's where we're at. And unless this breakout fails, we're probably going to see more upside in bonds. Remember, bonds, I always say this, I usually, when I throw a trade idea out, on at least a 2.0 beta adjustment. TLT, which, by the way, we nailed that bottom right there, which was one of the biggest runs in bonds in years. Traded it up, hit the final target, and then turn around, put on as a short up in here somewhere. We broke this trend line. We went down. We hit the top of my first target zone. We've recently been dancing, and we're still on the bottom of my first target zone. Again, that's from all the way back here. So this is how it works. We hit the top of the zone. We bounce. Then we hit this resistance line I had here, all in advance. These lines were up on that chart before. Created that back in 2022. And then down to the bottom. And again, just like the 10-year, we have positive divergence. So this tells me the odds favor a bounce. So two takeaways. Number one, if you did take that pairs trade yesterday, let's say, again, I said if you're short, you can go long treasuries right now. And, didn't specify yesterday, but I always do in the past. 2-time at least a double beta adjustment. I like to trade the long bond. You just get more juice. If the 10-year is going to go up, the 30-year is going up, and 30-year just goes up more. TLT is up 1%. IF is up 0.33. Now, I watch IEF because that's what the market cares the most about, and that's what mortgages are tracked to, but this is what I trade. And so there's a beta adjusted 2% today versus the Nasdaq being up down actually 0.24. So there's a great example of a paired trade where sometimes one doesn't have to win and lose. Sometimes if you get it right, both can actually be profitable. But again, they're based on RR profiles, technicals, and everything else. So I just wanted to say that. And then where to? Well, you can see, I'll tell you right now where to. There's a very mild resistance. To be honest with you, I'll have to study the charts of the futures a little more. Remember, TLT and IEF are ETFs. You're looking at trades from 9:30 to 4. Treasury bonds trade around the clock, just like the stock futures. So you have a lot more levels to pick up. You can see all the nuances, all the different reactions. There's minor resistance here, but based on the divergences and all that, it should carry it up to at least that 95 level, if not more. Again, based on the positive bullish look, last time we had positive divergence was right there when the top of T1 zone was hit. We got this. All right, so there it is. So, like I said, if you wanted to stay short right now, you have a partial short position as a swing position. It shouldn't be a full one. We never got those additional signals, but we're still not where I'm convinced that this, this whole thing in the video wasn't a 1 or 2 day pop. This is a great way to be indirectly hedged. And again, a 2.0 beta adjustment means beta is, that's the term I made up years ago, called a beta adjusted position size. And basically the S&P 500 is a benchmark. So if whatever your number is, whether it's 10,000 or 100,000 or a million, whatever you trade in the markets, or less or more, let's just say $100,000 position in SPY, that's a 1.0 beta adjusted position. That's about what you'd take in probably any of the market leaders, some big Mag 7, and they're a little more volatile, but SPY is a 1.0. And so if you put 100 grand and to go long SPY, then you put 200 grand long in TLT. Likewise, today I gave you a trade idea on a little penny stock. You don't see me post many of those, but every now and then, if I see an opportunity, I'll post it. That's what I do. I tell you what I'm doing, and if I'm not gonna, if I think I can make a buck on it, and I make very clear. Gunslinger trade, active traders only. Aggressive traders only. It's a penny stock. The risk of a penny stock, boom, you can get a bankruptcy filing out of the blue. But here's so I'm going to talk through this trade real quick. And by the way, on that too, as I often do, under any trade or video, anything I cover in a homepage post, whether it's a video or static charts, if I have additional notes to add, I'll do that. So. Shortly after it was posted, it went on to break out. I said, decent chance it could hiccup around the $1 mark, but if it can clear that, the first target will likely be hit today. You can't see. Typical hiccup, and then I followed up with a chart here. Typical hiccup / initial resistance on the initial spike into the $1 level, as is usually the case on a penny stock's first visit to that level in a while. A solid pop above 93 and then 105. This is a big one. High a day should take CARA to 130 in short order. Here's a 1 minute chart. So let me talk about that and again, please, if you're new to this and you're not experienced in trading, you're not an aggressive trader, this is speculative money. That's why I'm where I was segueing into this. The beta adjusted position size for this was 0.35, meaning 35,000 instead of 200 in TLT. It's a big difference. Why? Because the risk reward is a lot longer. Now, to me, the risk reward is really nice because I'm not giving a lot of room. If this breakout fails, the breakout was above 83 and the intersecting downtrend line today. If it goes much below that, then I'm out. And my RR is really nice. So I'd like to see it at 130 today. Don't know if it's going to get there, but I think there's a decent chance. So what I wanted to talk about real quick. Traded many things for years, including many penny stocks. It's not my thing. And again, I've already made clear on the risk. But what happens when you see a company that was not always a penny stock? If the companies that are been penny stocks for years, I usually stay away from them. The ones I like are the ones like this. CARA, we have had many trades in the past. If you click on the ticker symbol, you'll see trades, a lot of trades on this one. And CARA Therapeutics, biotech. But you can see it just, since it broke this support right here, 746 right there, it just, ooh. And then what it did is, here's the $1 mark. Let me put a line up for you just for the video. $1 is right there. And so what happens is, companies that are listed on exchange and Nasdaq companies as well, if they trade below $1 for a certain period of time, I forget what it is, it's in the agreement with the exchange, they get a delisting notice. That delisting notice says if you don't get your share price above $1, you're going to get delisted. You're going to the pink sheets, and then there's less liquidity. Reporting requirements are different. So institutional investors a lot of them can't own those stocks if they're not listed. And so what I've noticed is once you go below it, that $1, it's a big thing if you can regain it. And a company will do, off my experience, whatever they can, including and not limited to insider. But a lot of times they'll do a reverse split, but if they don't want to do that and the cost, expense, and time, they'll do insider buying. Insider who has money. Oh, let me just buy a bunch of the shares. It's low float anyways. So that's it. So now that's just an intraday spike. But if we can solidly get above there, that increases the odds this thing might go all the way up to my third target. Today, if we hit 130, I'm happy, in and out. Or if we get below, the breakout, especially down below the trend line, I'm not happy and throw it away. And like I say, nothing ventured, nothing gained. So you win some, lose some. But as of now, you can see when you look at the 1 minute chart, there's that $1 level. It's 105 was the previous high. And then they popped it. That's what it said. They popped it. There were a lot of buy orders. Unfortunately, there weren't a lot more on the other side of it, but there were. You can see that big spike up once 105 was popped. Did put in a little divergent high on the 1 minute, but so far so good. I like it because the volume's hot right now. The volume on this one's tracking according to at about 1,200% above average. Or the volume buzz on TC2000. And you can, all you have to do, guys, is look at it. Look at the chart, and you can see the bar up, and know that we're still in the morning session right now. So this bar by the end of the day is going to be a lot bigger. And anywho, that's that. Take it, don't take it. I just wanted to share that whole point that I was making about, updates, which I'll continue to provide in the under here. They're not going to warrant a front page post. This is most people listen to my voice probably should not have taken this, especially if you again. I can't advise. I can't tell you what to take, what not to take, but this is what I call Vegas money. So I call it a gunslinger trade. When I say Vegas money, take what you put in your pocket if you're going to the casinos, because you're gonna, chances are you're gonna lose it. Obviously the odds are better. I would never take a casino trade. So I'm not a gambler. I don't like casinos. Walk into a casino, and every table you sit down to, you are guaranteed the odds are against you. It's how the casino makes money. Every single game, you can Google search, the odds are there. Roulette, blackjack, it's all, it's all there. But obviously I take trades that have favorable odds, and that's what trading's all about. So don't take unfavorable trades. Okay, what else do I have for you? One or two more things. Let me just get nat gas out of the way quick, because I notice it's down pretty good today, but it's still above the initial breakout, and so still looks okay. I mentioned an objective add-on or new entry back at 1572 on UNG, but remember UNG, and this is again, I say it repeatedly, the one reason that I prefer futures. You missed the breakout. It happened on the futures and it went up. You had the trade there on NG futures, but because UNG is an ETF or ETN, it says here ETF. I believe it's an ETN, but either way, you're only trading 9:30 to 4, and there's really crap liquidity, especially in this one in the pre-market and after-hour session. You can only trade limit orders. It's almost impossible to chase something or get it from limit orders. And so here's what the futures look like. Like I told you yesterday, I rolled, from the March. We originally had the breakout of the March. So we went up, boom, hit this second target, pulled back there. We're below it. So here's what I would say to this. I wouldn't add to it here because we took out that support level. That's not ideal, but it's still above. Number one, it's above the breakout point, the initial entry. If you took that one, it's posted in the week or so ago in the comment section there. And there's your uptrend line. It'll probably come into play there. And again, you do want to see the next buy signal would come on a break above here or a break below that trend line. That's a good level to put a stop either there or at entry if you took the breakout, because there's also the breakout was dual downtrend line plus horizontal price support at about, which again, not on the original chart because that was a March. These things roll. This is the April contract, so the numbers change. 164 right there. So there's your update on that gas. Okay, I wanted to expand on this one. Yesterday I talked about what I'd call a potential yellow flag. And, it may or may not have registered. Some of you said, well, Randy, what is market? I've never even heard of market access. What do they have to do with the market? And after I covered that, it hit me. There's, this is a stock. Again, I've traded it for years. Know what they're one of the big leaders in the bond market, bond trading and all that. And and something that I've noted in the past, and I do this with a lot of stocks. There's a handful of stocks, and this one is in my TTW things to watch list. That's a watch list I created a year or so ago of key stocks. I have some of them no relation. I have, for example, ADP and Paychex, PAYX, two big payroll processors. I have UPS and FedEx. I have things that are or have the potential to be very important to the stock market or the economy. And a lot of times you can glean useful predictive value depending on what these guys are doing, bullish or bearish. And so let me show you. So this is market access, as I mentioned, peaked back in 2020 and it's been going down, had a big rally right then when the stock market bottomed and the bond market, remember, yields falling. And so they're tied into the bond market to a large extent. I mean, they're their stock price to profitability. When, everyone wants to buy bonds, they're making more money. They own a bond trading exchange. All right, so let's do this. We're going to go to a weekly chart. And I'm going to do this just with 2 stocks, and we'll wrap this video up. This one, FedEx. I can do it with more, but so what I've noticed is, and I talked on it yesterday, but now let me show you the significance hey, something doesn't seem right. This is I went to a weekly time frame. I put line charts to make it very easy. So MKTX is in yellow. I'm sorry, white. And QQQ for the stock market, I'm using that proxy, is in purple. And you can see when you go back in time, if I turn off all the lines, you can see a almost perfect. And this is when market access went public in 04, so you really can't go past there. And again, when I talked about correlations, don't look at the separation lines. Look at the ebbs and flows. Look at the trends when they turn. And so market access typically moves in very tight positive correlation with the stock market. However, this is where the whole predictive value comes in. I have to say, and I say this often, when I point out things such as divergences between 2 assets that normally warn of a problem with one or the other, those are not, and they're far from timing indicators. In fact, I put some times up here for you. So what I did here is when market access peaked, right after a rally or major trend change. And this one's been going down, it goes down, usually has a big kickback rally, and it's been going down. And this one's heading at closer to new multi-year, even all-time lows than it is all-time highs. Yet the Nasdaq 100 has gone completely, and the stock market completely in the opposite direction. So you say, okay, Randy, well, this stock's not relevant anymore. Well, you go back in time. And so what I'm doing here, this is start, and I don't have a yellow line here because we haven't seen a definitive turn in the market yet. And at that point, there will be. And then you'll see, as of today, these 2 have been diverging since MKTX peaked. They've been diverging now for 10.8 months. And you can see normally they trade in lockstep as they did from here. So this is the next start point. Start right there, MKTX peak. That was back in October of 2020. Clearly began a downtrend. Took a little while at first, but got going. And then something happened at this point right here. After exactly 1 year, the Nasdaq peaked and fell. Had its biggest drop in many, many years. In fact, one of the biggest drops in decades right there. So you're going to call it random coincidence. That's up to you. Again, normally I should have probably shaded these boxes or done something. This is box 1, box 2, box 3, and box 4, which is still in the works. And so you can see in a normal market, after these divergences play out, so this is MKTX peaked here, 5.3 months later, right there, the Nasdaq peak, COVID hit. Somehow MKTX knew, something in the bond market knew something was coming. And I've talked about this many times, the divergence on the stock market. But then you had, again, a 36% drop in the S&P over 6 weeks, which would have been a whole lot more had the Fed not come and all the central banks pulled out a nuclear response to the pandemic. So again, MKTX warned, hey, we're going down, market's going up like it's 1999. That's a red flag. Took 5 months, 5.3 months from that divergence. By the way, guys, I'm not cherry picking these turns. I know offhand, I can cite at any given moment the biggest drops that we've had really in the past couple of decades. You had 2 real bear markets, 2000 to 2002, and then 2007 to 09. And then some corrections that you could define as corrections, I do, or bear markets. And, if you want to use a 20% drop. So this is COVID. We all know that. This is what just happened in 2021 to 2022. And this was the big Q4 2018 drop, which was a bear market in some indexes, many stocks. It was the biggest drop, really, I believe, since the last financial crisis. And so, again, I didn't cherry pick these, and these are the only times you see these such stark divergences. MKTX peaking right there, and I don't have I can give you the dates. You can do it yourself, overlay the 2 charts. That was March 16th, the week of. and then it dropped, clearly was dropping, and then 5.5 months later, that big drop in the fourth quarter hit. Other than that, in hunky-dory times when the stock market's going up, without fail, MKTX is trending up as well. So take it for what it's worth. I rolled all the way back because remember, since the financial crisis, we didn't have much. That was when the bear market ended. And I have to say this, when you're on these long-term charts, let me go to a log chart. Yeah, log chart makes it look easier and better. Okay, but what I need to do too is zoom back in there. I already made the points. You can measure the drops if you want. So we're going to go back in time now to show you, this was it back here. So the stock market, both that Nasdaq 100 and the S&P 500, before the Great Recession, the financial crisis, they both peaked in October of 2007. That's what I circled there. There's Nasdaq peaking. And MKTX peaked back there. I thought I had it measured. I might have. I have to go back a little. Yeah, it was 3.9 months. So it seems that the cycle, it's peaking earlier, but everything is on juice. I call this market the super size. The Fed, when McDonald's a few years back, they started supersizing everything. You could order a giant tub of fries, a gallon of Coke. If you supersize it, that's what everything has done. The magnitudes of the waves, the corrections, and the rallies have been a lot larger with more and more Fed and central bank intervention. And so maybe that's part of why it went from 4 months to about 5 months to a year. And now we're coming up close on the year mark. So again, the takeaway is, what do? You go short all QQQ? No, you short QQQ if and when on the objective sell signals. We've had a few lately, but we don't have the all-in kind of get aggressive one yet. In fact, right now, and it might be probably going to carry in the next week if we close close to those trend lines again for me. More concerned about just throw that hand away on those swing shorts and wait for the next opportunity. But again, this speaks volumes to me. Again, I have quite a few companies you can do this with, but the other one I have is FedEx. I haven't measured the times, but you can see them. So we can scroll back. See, I was going to work on that, but what's the difference? You can do this yourself. So here's what I want to show you. This is one, and I've been watching closely. So these are what I call, leading indicators, if you will. They're not your traditional leading indicators you get on economic sites, but these are some of the ones I use. And I don't have to tell you this, but maybe if I do, if you're brand new to the financial markets, FedEx and UPS are considered economic bellwethers. Obviously, when the economy is strong, they're shipping more, they're doing more business. They're flying more planes full of cargo, delivering more packages, more closings on real estate with signed documents, being FedEx or UPS. You can do the same with UPS. And again, this divergence, you don't have to squint to see it. This is FedEx. It's clearly peaked back in December and is clearly in a pretty big downtrend. And the stock market's going up. Again, very important that when you look at these comparisons, FedEx has dropped before. So just because FedEx is going down, that's not a red flag if the market's going down, because it knows it. That's exactly what's happened here. They were both in lockstep. You can see the purple and white lines. Again, FedEx is in white, QQQ is in purple. Normally, they're trending together almost in lockstep because FedEx ultimate fate and profitability is intertwined with the stock market. But when all of a sudden FedEx and all these other things that I'm showing you now, they're going down like I've been talking about. And we went from the Mag 7 to now what I'm calling the Mag 1. Hey guys, it can go on for a while. I traded through the dot-com bubble, so don't fight it. Don't short it because you got to wait for the proper sell signals. But these are clearly telling me, unless all of a sudden FedEx turns around and starts to rally and plays a big game of catch up here, this is a big warning sign. And again, it can. And the point that I do these lines, it can take years to play out. You can see the dates down here. I'll tell you. This one was the last time around we had it. It was. I have to go. Here's what I have to do. I have to turn off the lines so I don't move them. FedEx peaked here, and the Nasdaq peaked right there. That was about 6 months. And right now, FedEx peaked here, and the Nasdaq's still going, and it's been only 2.5 months. But there's other periods on there as well. You can see it there. Again, without fail, they move together. The corrections, FedEx dropped, the market dropped, then they rally. But when they start to diverge, FedEx peaked right here, back in right at the beginning of 2018, was falling into this point, and that was the big Q4 2018 drop. So again, I'm not picking these just random arbitrary things to fit a case. These were the big drops. In fact, this was COVID, and to be honest with you, I didn't put lines there. That was another big drop, but FedEx was already still going down, and it started to rally right here. It had a nice rally, a nice turn, but then it was heading down long before COVID hit, as if it or the market knew it was coming. Take what you want out of that. I'm not a conspiracy theorist. I don't know. It's just you do know the markets are, there's millions of intermediaries interacting, and those in the know at the highest levels, insiders to these companies, those in Washington, we know that there's no insider trading rules for them. They all this stuff, people that maybe work at the WHO and maybe knew something was going on with potential coronavirus, who knows. But all I can tell you is, without fail, you can see these correlations. Positive. When the economy's growing, the stock market's going up or down, they move together. But all of a sudden, when FedEx peaks and starts dropping and the market still goes up, something's coming. That was the financial crisis. That was a 55+% drop. It doesn't look like much here in both the Nasdaq and S&P 500. And this was in the dot-com bubble. FedEx peaked in early 1999. This was the blow-off top in the dot-com bubble. FedEx was going down, saying, nope, the economy is not good, despite everybody being giddy on tech stocks and right now AI. There's something going on here. And then the bigger the divergence, usually the bigger they fall. And that was I think a 78% drop, if I'm not mistaken, in the Nasdaq composite. Those about the top dot-com bubble. And you lost more if a lot of the dot-com companies went to zero, but okay, and again, I think these charts speak volumes, but longer term analysis, not actionable. Actionable in the way, then you might ask, well, why do you even share it? It's actionable in the way that when we get those sell signals, the higher probability sell signals I'm talking about, it helps at least me formulate, am I going to go for, am I looking for the next short trade to be a 10% correction, or am I looking for a major turn in the markets, like one of these that we've had in the past that measure well into the double digits because of these leading indicators and everything that's going on underneath the hood. All right, I will wrap it up here and continue to hunt for some new and different trade ideas. VIX, by the way, is still holding up relatively well. I said I'd stop, but I just want to point that out. I watch these things. You can have some VIX futures. And the VIX has come off that divergent low. It's moving up despite the market. S&P, remember, the VIX tracks the S&P 500, not the Nasdaq 100. The S&P 500 put in a new high yesterday, but here's the VIX bottom back here. So just like it tends to turn, puts in these divergent lows, starts to move up, you start to see volatility spike, and then one day, boom. And anywho, I highlighted as a trade idea back here, and it's still looking good. But you really, if you can't make a case to be short the equity market right now, I wouldn't add to a short right now. Like I said, we're above that trend line. You need to at least lose that. Ideally, lose last Tuesday's lows. At that point, if that happens, then that would be a time to either take or add to the VIX. Right now, just like the stock market, I'd be more concerned about stopping out if the Nasdaq 100 can hold above the trend line and everything else. So, all right, that's it, guys. Wrapping it up here. Looking, bullish treasuries at the moment, kind of market neutral or waiting to see what happens on the stock market. What else? That's probably the main stuff right now, other than that little penny stock play. We'll see if that works out or not. This has been Randy Finney with Right Side of the Chart. Have a great day.